The struggle for East-West supremacy could be anywhere, as we see an increasingly divided global order with regional spheres of influence arising. The recent escalation of US measures against Venezuela, including the seizure of sanctioned vessels and proposals to redirect Venezuelan crude to the US, marks a pivotal moment for global oil markets. These actions occur against a backdrop of oversupply, with projected stock builds of 1.4 to 2 million barrels per day through early 2026, and rising geopolitical tensions involving China, Russia, Iran, and Europe. While the headlines suggest dramatic shifts, the underlying fundamentals remain bearish, but the geopolitical dimension introduces significant volatility. If sanctions tighten further, Venezuelan exports could fall by 200,000 to 600,000 barrels per day, deepening storage constraints and forcing production cuts, particularly in the Orinoco Belt. This would marginally tighten heavy sour crude markets, supporting high sulfur fuel oil cracks and widening light heavy spreads on the US Gulf Coast. However, given the global surplus, the overall impact on balances would be limited. Alternatively, a partial sanctions relief scenario could see Venezuelan exports to the US Gulf Coast rise by 200,000 to 400,000 barrels per day, restoring flows closer to the pre-embargo levels. This would displace Canadian heavy barrels and reduce Chinese intake, forcing Chinese refineries to seek alternative heavy grades from a Latin America or Russia region. A third scenario involves strategic realignment, where Venezuela pivots towards China and Iran under prolonged US pressure. This would create more complex trade routes, higher freight rates, and increased ton miles for Aframax and VLCC segments, while insurance premiums and compliance risks add cost layers to sanctioned barrels. The US move signals a broader willingness to weaponize energy flows, amplifying uncertainty across spheres of influence. China is likely to defend its access to Venezuelan barrels, possibly through barter deals or transshipments via Malaysia and Singapore. Russia and Iran could deepen cooperation with Venezuela, leveraging grey market logistics to sustain flows. Europe faces indirect exposure through refined product markets and tanker disruptions, while grappling with refinery rationalisation amid declining margins and structural overcapacity. Despite these developments, fundamentals dominate pricing. Global crude oversupply caps upside risk, with Brent hovering near $60 per barrel, and bearish sentiments prevailing as markets anticipate incremental Venezuelan barrels entering the US system. Heavy sour crude differentials are most sensitive. Increased Venezuelan supply would pressure these spreads, while deeper sanctions could offer only modest support due to a conversion economics at complex refineries. Venezuelan grades, which are medium to heavy sour, are ideal to US Gulf Coast coking refineries, enabling higher secondary unit utilization and diesel output. Modern Asian and Middle Eastern refineries are equipped for deep conversion and could absorb displaced Venezuelan barrels if US access tightens. In Europe, rationalisation accelerates as heavy feedstock economics deteriorate, reinforcing closures of simple refineries and favouring complex plants in the Mediterranean. Trade flows will shift significantly depending on the embargo outcome. Relaxation would redirect flows from China to the US, reducing ton-mile demand in the Pacific. Conversely, prolonged sanctions push Venezuelan crude deeper into opaque networks, raising compliance costs and freight volatility. While oversupply anchors price trends, geopolitics injects volatility. Event-driven risks from tanker seizures to diplomatic realignments will overshadow structural factors in the short term. For market participants, agility in managing compliance, freight exposure, and crude slate optimization will be critical as the Venezuelan saga unfolds.